FAR Limited is a West African-focused oil explorer. Primary assets lie offshore and deep water in Senegal. The company made two large discoveries in 2014, FAN-1 and the SNE-1 discovery wells. Subsequent to that, the company's been in appraisal mode, sinking wells, doing flow tests across the SNE field, and has steadily built up what currently stands as an independently assessed gross contingent resource base of just a bit over 500 million barrels of oil. So we look at FAR in the context of the mid-cap oil coverage that we run here at RBC, and what attracts us to the company and the assets is really scale. So at the risk of stating the obvious, the oil resource discovered offshore in Senegal is big, really big. So 500 million barrels, to give you some context, is about the equivalent of the sum total of oil produced out of the whole of Australia over the past 5 years. So that sits in just one field in which FAR has a 15% net interest in that joint venture. At RBC, our oil price outlook is for a calendar year 16 exit rate of $53 a barrel. We've got a CY17 average of $60 a barrel, trending up to a long-term nominal oil price of $80 a barrel. So by that you can see we remain constructive on oil, notwithstanding the strong rally that it's already had over the course of this calendar year. Now there's two things that drive our view of a continuing recovery in oil. One, we foresee by the end of calendar year 16, a reversion back to net inventory draws across the globe. So that basically implies for the first time in about 2.5 years, the world will be producing less oil than it's consuming and making up the difference from some of the large inventories we've seen built up. Secondly, we perceive heightened and increasing risks of supply from some key oil producing nations, namely Venezuela, Nigeria, and Iraq. So those three nations have been producing at a level we believe is out of step with the geopolitical and civil issues that exist within those countries. We see three primary risks around firming up the commerciality of an oil field, outside of oil price, of course, which is a key driver. So firstly, you've got oil in place. Secondly, you've got deliverability of the rocks. Thirdly, you've got continuity across the field. Now, the first two of those risks, we believe, by virtue of the appraisal wells that have happened to date, have largely been covered off. There's a big amount of oil in place. The rocks deliver according to the flow tests that have been conducted to date. It's the last factor, continuity across the field, that is yet to be determined, and that will be determined in the future around something which is called an interference test. Now, the outlook for FAR as we see it going forward, as I mentioned, there'll be a lot of data analysis based on the wells that have been drilled over the last 6 months. And secondly, we may well see some changes to the joint venture structure. Now, I'd highlight none of the joint venture parties are financially stressed or forced sellers, but would see this asset as being very appealing to potential suitors who are looking to reposition portfolios ahead of what we see a recovering oil price environment, albeit one that may be increasingly volatile going forward. RBC's rating on FAR Limited is outperformed. We have a 17-cent price target versus 8.5-cent share price currently. Our view fundamentally is we see it as one of the rare opportunities to get a pure play investment on a high quality oil resource that's growing and progressively de-risking in an environment of declining costs across the oil industry and what we see as a recovering oil price. So fundamentally, it's a core pure play exposure on a single asset that we see as very high quality.